In venture capital, a startup's ability to adapt and pivot strategically can define the ultimate success or failure of an investment. Some of today's leading companies, including Slack, X, and Shopify, initially pursued very different ideas before pivoting toward the markets where they eventually thrived. For venture capitalists, recognizing when a pivot is necessary and supporting it effectively is essential to realizing strong returns. Successful venture investors understand that startups often face critical junctures where their original vision no longer aligns with market realities. Signals such as weak customer adoption, unsustainable business models, poor unit economics, or emerging market opportunities often indicate that a pivot might be necessary. Additionally, competitive pressures or regulatory changes can compel startups to reconsider their strategic direction. Investors must stay vigilant and open-minded, closely monitoring performance metrics, market feedback, and competitive dynamics. Early recognition of these pivot signals allows investors to actively support founders in navigating necessary changes without delaying decisive action. When a pivot becomes inevitable, investors play a crucial role in ensuring it's executed smoothly. They must work closely with founders to validate the new direction through in-depth market research, customer insights, and pilot projects. This validation process ensures the pivot aligns with the startup's strengths and market opportunities, significantly reducing the associated risks. Clear communication and strategic alignment with founders are critical during a pivot. Investors should foster open dialogue to ensure that the management team understands and supports the rationale behind the pivot. Investor endorsement provides critical reassurance, particularly if additional capital is needed to fund the pivot or to stabilize the company during the transition. Internally, investors must support the startup as it navigates organizational changes, ensuring that necessary adjustments in roles, incentives, and operational structures are implemented effectively. Transparent communication with the broader team is essential to maintain morale and minimize disruption. Externally, clear market communication is equally critical. Investors should guide startups in repositioning their brand and messaging, framing the pivot as a strategic evolution rather than a reactionary move. This maintains customer trust and builds confidence among stakeholders. Investors should approach pivots with a careful assessment of financial and operational risks. Maintaining adequate capital reserves and closely monitoring burn rates can mitigate financial stress during the transition. Additionally, investors should encourage startups to clearly define and communicate success metrics to track progress effectively. While pivots carry inherent risks, including potential loss of talent, increased capital burn, and customer churn, proactive risk management significantly improves outcomes. By facilitating structured, data-driven decision-making and transparent communication, investors help portfolio companies navigate pivots successfully. Some of the most successful startups did not begin with the products or services that eventually made them famous. Instead, they pivoted, shifting their business models in response to market realities. The ability to recognize when a change is necessary and to execute that change effectively has been a defining trait of companies such as Slack, YouTube, Shopify, and X. Slack's origins trace back to a gaming company called TinySpec, which developed a multiplayer game called Glitch. Although the game failed to gain traction, the team had created an internal messaging tool to support their collaboration. That tool proved to be far more valuable than the game itself. Realizing a broader market opportunity, the team shifted its focus to workplace communication, ultimately transforming Slack into a multi-billion-dollar enterprise platform. YouTube also began with a different concept. It was originally launched as a video-based dating site, but the platform did not attract the level of engagement the founders had hoped for. What they observed instead was that users were uploading a wide variety of videos unrelated to dating. Rather than forcing their original vision, the founders embraced this behavior and repositioned YouTube as a general video sharing platform. This shift led to its eventual acquisition by Google for $1.65 billion. Shopify started as an online snowboard shop. The founders were frustrated by the lack of reliable e-commerce tools, so they built their own platform to manage the store. It soon became clear that the software had greater potential than the snowboard business itself. Recognizing this, The team pivoted to become an e-commerce infrastructure provider, and Shopify has since grown into a global leader in digital commerce. X's story began with a company called Audio, which focused on podcasting. When Apple launched iTunes with built-in podcast support, Audio's original business model became obsolete. In response, the team shifted to a microblogging service based on short status updates. That pivot gave rise to Twitter, now X, which went on to become one of the most influential social media platforms in the world. Each of these companies succeeded not because their first ideas were perfect, but because their teams were able to identify new opportunities, build on existing strengths, and make strategic shifts before their resources ran out. For venture capital investors, backing founders who are capable of making these kinds of pivots is essential. Often, the greatest returns come from teams that are willing to adapt and redefine their vision. For venture capitalists, the ability to support and manage effective pivots significantly enhances portfolio resilience and growth potential. Rather than viewing pivots as failures, investors should see them as strategic opportunities to realign startups towards stronger, scalable futures. By recognizing signals early, validating new opportunities rigorously, and communicating clearly throughout the process, investors can turn potential crises into powerful growth moments, driving sustained value creation in their portfolios.